Before Wednesday, President Donald Trump's tariffs were expected to be a problem for markets and the economy, but a manageable one. So much for that idea. What happened instead is something worse than the worst-case scenario, which previously had been one where the US would slap true reciprocal duties on its trading partners that would match tariffs charged to American exports. In a perfect world, that would have triggered a round of negotiations that led to deals all sides could live with, as part of a Trump effort to change the trajectory of global trade, reshore American jobs, and transform the US from being dependent on cheap foreign imports and lavish government spending to a production-focused economy. Fears around that scenario were focused on a spark to inflation and perhaps a slight slowdown in growth. What actually emerged, though, has been economic, market, and geopolitical mayhem. It started with Trump's Rose Garden news conference Wednesday after the market close, when the president recited almost gleefully his intentions to, quote, pry open foreign markets and break down foreign trade barriers. The plan: slap 10% tariffs on every U.S. trading partner starting Saturday, with individualized rates for 60 other countries that would begin in a week. Virtually overnight, the effective U.S. tariff rate was set to spring from 2.5% to well past 20%. For perspective, that has the potential to be the highest level since 1910. Higher even than the devastating Smoot-Hawley tariffs of 1930 that many economists see as contributing to the Great Depression, putting an exclamation point on Trump's anti-globalist, maximalist protectionism that went beyond Wall Street's worst fears. If Trump was playing chicken with the rest of the world, he lost round one. China retaliated with 34% tariffs on all goods. European Union leaders also are considering countermeasures, and the suddenly antagonistic relationship with Canada and Mexico will have to be smoothed over during United States-Mexico-Canada agreement talks in coming months. Markets recoiled at the developments, sending stocks into a vicious two-day sell-off that put the Nasdaq Composite, home to powerhouse Silicon Valley names that Trump has been courting in the early days of his second term, into a bear market. Economists, meanwhile, were aghast at the rudimentary math that went into calculating the tariffs. Essentially, the administration, in a plan the Washington Post reported was being cooked up until 3 hours before the announcement, simply divided the trade deficit with individual countries by the total value of U.S. exports to devise reciprocal tariffs that don't appear to live up to their billing. According to the Center for Strategic and International Studies, the formula punishes high-deficit trading partners from which the United States imports a lot and buys little from, not necessarily those with the most restrictive trade regimes. In short, the formula provides rough justice at best, blunt force at worst, the center said in an analysis.